Well, good afternoon and welcome to the inaugural episode of the new ERM Advantage podcast. I've been very excited to put this together to complement the training videos that I've got up on YouTube. I wanted to have a platform to be able to talk about what's happening in the industry, both my own observations as well as others. Some episodes I'm going to have guests come on from within the industry of different expertise, and some episodes I'll just talk about myself on observations on what I see happening. The videos will continue to focus on training around risk management principles, and this platform is going to be around covering trends in banking and risk management, compliance, or anything else that we feel like talking about. And I'll circle back every once in a while to cover topics as new information comes out. But again, I just want to be able to have a platform to be able to kind of talk about what's happening in the industry. In this podcast, I'm going to cover just banking in general. Just kind of talk about kind of banking and strategy, what sort of the moving parts and headwinds and opportunities that bankers are facing. A little bit about the regulatory environment and more specifically some observations on the regulatory environment. A little bit on some of the major moving parts, data, digital, AI, fintech, and all that. And then I'll talk a little bit about kind of the future of banking and sort of where I see this all going. So sit back, enjoy, listen, and I hope you find something here useful. All right, so to start, just talking about kind of banking in general, I think we're at an interesting, if not strange, point in banking. Having been in this industry for 30 plus years, I've seen a lot of changes, and I think we're just at a really, really interesting inflection point. I think there's a number of opposing forces that bankers are facing, which represent both opportunities and threats. I think the bottom line, though, is banking is going to be changing, and I'm going to talk about a number of ways I think so. Industries in general always tend to evolve, but with the convergence of things like AI and fintech, and just technology in general, introduction of digital into the environment, all things I'm going to talk about a little bit. I think there's a lot of fundamental changes we could see happening. I think it's important for banks to understand this, to think about how they're going to both position themselves, strategize, and be able to exploit opportunities while defending against some of what I think are some shifting sands. Again, we'll talk about all that. I think one of the key points and underlying all of this is something I've been saying for some time, is that I think banking is going to look differently in, say, 10 years than it does today. Again, using all those different factors and what constitutes a bank and banking, I think banks are going to start to look different. And so it's important for us to consider what a bank of 10 years from now looks like, and then how do we need to sort of reverse engineer to be able to thrive in that environment. So, in the meantime, a lot of it is business as usual. All fighting for all the good credits out there, for low-cost deposits, for, sourcing and retaining key talent. None of that ever changes. Trying to differentiate when, many offer very similar products and services, while navigating all the external factors of the economy and competition and the regulatory environment and the ever always increasingly clever bad guys. But again, I think there's a number of things we should think about and should be really considering as part of our strategy and operations. Certainly broadly, our economy is a bit uneven right now. Again, I think there's a number of different factors that are influencing that. And that it kind of is always the case. But again, I think there's a little uneven ground that we need to be aware of, and being able to adapt, as things play out over the next couple of years. But the reality is that an institution should be able to thrive in any economy. There are times when you have to trim your sails. There's times when you let them out. I don't know that this is necessarily distinctly one or the other, but I think it's important to understand that there's a lot of unknowns right now, and so this is important to be considering these and honestly considering a range of plausible scenarios that could play out over the next few years. I think banking isn't as simple as it used to be. Again, having been around a long time, I think it's going to continue to get more complex, particularly as we're seeing more technology, the introduction of a lot of non-banking players. And so I really do think we're kind of at an inflection point where there's going to be some decisions that will decide who in the long term really thrives versus who may not, or maybe struggling to be able to sort of carve out their piece of the pie. We're going to get into some key factors throughout this that I think will be material in who really are the survivors and who are the thrivers. All right, let's talk a little bit about bank strategy. And this is an area that I've always had a lot of appreciation for, both because it is a critical component, obviously, of management and risk management, but also because it's an area that when I've worked with a variety of different clients, they approach this sometimes very differently. In some cases, I've had institutions that really all they did was just kick the dust off of the last 3 to 5 year plan, maybe true up a few elements, add a few new line items, and that was about it. And others that were really willing to take it back to the studs every once in a while. And I think the right answer is somewhere in the middle. I think that just kicking off the dust is no longer a viable approach. Reinventing every year is also not an approach. So the question is how should we be thinking about strategy? So I want to offer a couple of observations, and some of these, I may be off, but again, I think these are observations that I'll be able to test with guests that I have on in the coming months and throw some of these out there and say, what do you think? Am I on? Am I off? What do you think? Number one, I think, again, having worked with many, many institutions and just seen many, I think there's a general tendency to focus a bit too much on the commodity products we offer and focus on products and not enough on relationships. Now, to some extent, that's a little more of a consumer issue than a commercial, because on the business banking side, it always has been a relationship-based banking. But again, there at times seems to be a real focus on who can we sell what to. And I think part of what really is going to differentiate is being able to really look at this from a relationship standpoint, not just a what can we sell standpoint. The other thing is that for institutions that, again, are offering commodity products, it's the same stuff that everybody else offers for the most part. If your pitch is we have great service, you may survive, but you're probably never going to thrive because everybody else is selling the same thing. Maybe you really are that much better, but I'm not sure. So again, I think we've got to find a value prop that is more than just, hey, we offer checking, savings, loans, safe deposit boxes, and we give great service. There's going to have to be more than that to be able to survive in an environment that's becoming more complex and, frankly, more competitive. Service is only a reaction. It's only a response. Great service is proactive. We know what you need before you do. Sometimes I see banks that they see great service as sort of the holy grail of success. But ironically, many leading tech companies that is increasingly becoming your competition don't really put a priority on it. In fact, there are a lot of technology companies that are terrible at service, and yet they're doing fine. So the question really becomes, what if what the customer wants is ease of execution, speed of execution, more than, we're friendly and we pick up the phone? Again, not saying it's one or the other, but it's something we have to consider. Plus, as we become more virtual, as you start banking beyond your physical footprint, and you're looking to bank in areas where you may not have a physical presence, it sometimes becomes hard to translate great service into a virtual delivery model. Not saying it can't be done, but it's something that has to be thinking about. How do we extend that great service into more virtual? This is in part why a lot of the fintechs are a bit of an existential threat, because a lot of kind of the next generation of customers is a little more focused on delivery. And frankly, sometimes they trust technology or technology companies more than they do banks, and that's a problem. So again, I think sometimes the thinking is a little bit too linear, a little bit too, again, product focus, but we're going to have to think a little bit more broadly, a little more holistically, and I think at times be able to rethink our entire model. The other thing is I see too many strategies that are based on instinct. We've always done it this way, as opposed to more of a data approach. And this is problematic, and it's become more and more problematic. I'll talk a lot more of this later because I'm going to talk about data and data usage. But anytime I hear, particularly in the context of strategy, people saying, well, look, we've always done it this way. We've been doing this a long time. We're just going to keep stirring the same soup. I get nervous because, I've been saying for years and years, risk always lies in the assumptions. And I think one of the most dangerous assumptions that we could make is we've always done it this way, so it will always work. That to me is scary. And I think something that has to be really wholeheartedly challenged as we think about what the next generation of banking is. One of the key problems that I see very commonly with institutions as they're thinking about strategy is they have real trouble defining what a future state is. What do we want to look like in 5 years? Or who do we want to be in 5 years? Now, I understand this is not a simple question. It involves a lot of elements, and not for nothing, but it involves putting a stake in the sand with who it is you are intending to become. But the problem is, if you haven't defined your destination, how do you know if you're on the right path? This could also be a little bit sticky, I get, because, look, at the executive level, if the future state is to sell the bank, you don't want to put that in your plan. So I realize there has to be some discretion in this. But for any institution, I think it's really critically important to be able to put pen to paper and say, look, based on the trajectory we're on, the strategy we're trying to execute, it's based on the idea that we are trying to engineer to a future state that looks like X. Now, that could be defined in terms of market share, in terms of size, in terms of diversity, a whole range that you could define what that future state is. The problem is when I see a strategic plan that says we're going to do this, we're going to do this, we're going to do this, we're going to do this. Okay, I'm not saying there's anything wrong with those, but are those getting you to a place you intend to be as opposed to just increments of what you already are? So I think this is really key when thinking about strategy, is to really come up with a vision as to what you think you want to be in that time. Make sure there's consensus amongst your leadership team that, yeah. And I think that has to be juxtaposed against, again, that question of what is a bank going to look like in 10 years? It's great if you say we want to be X, but if the market isn't going to want X, well, that's a bad idea. There has to be some consideration about what that, again, future state needs to be to match what a future demand is going to be. Now, change and adaptation can be hard. I get that, because part of this implies you might need to work to become something that you aren't today. Sometimes when we're comfortable with the devil we know. But again, part of maturity is being able to say, look, it was nice while it lasted, but we are going to have to become something fundamentally different. And what's that going to look like? How are we going to do that? Now, one of the key considerations here, and I talked about this earlier, is the fact that for as long as we've done banking, it was always predicated on one central fundamental truth, and that banking is banking dollars. We've always had an environment where if you wanted to transact, you were going to do it through a bank, which was the customer side of our Federal Reserve banking system. That has been all well and good, but what if that is no longer true? And we're going to talk about this when we talk about kind of the future of banking. The way banking could be changing could be more multi-currency. That could involve a digital currency. It could involve multi-platform, which is not just a Fed-based system, but more of a wallet-based system. So again, as we're thinking about change, we've got to be able to consider the possibility of what if the fundamental foundation of banking is also changing, and how are we going to adapt to be able to thrive in that environment? One of the things we need to keep in mind, and I think is a very important consideration as we think about that strategy, that roadmap, is banks fundamentally have one true asset. It's not we do checking, good for you. So does everybody else. It's not we do savings. It's not we make loans. It's not we do great service. Okay? A bank's fundamental, immutable asset is the fact that there's a trust factor. It's the one thing that is truly differentiating banks from fintechs is we fundamentally trust our financial system. And although people may badmouth banks, and sometimes justifiably, there really is a trust factor there. So the question we have to ask is, how are we going to adapt and evolve into a future state where banking may look different, but we still leverage that one singular asset we have, which is people trust a bank? So we'll talk about kind of what that looks like and how we leverage that. I think the key thing is what questions are we asking ourselves? And when I talk to a lot of institutions and I talk to them about strategy, frankly, I think they're asking all the wrong questions. Sometimes they may be focused on, again, how do I sell more checking accounts? Wrong question. How do I open more accounts? Wrong question. So in the end, I'm also going to talk about a handful of questions that I think are the questions you should be asking within the context of setting strategy. So we'll get to that later on. All right, let's talk about the regulatory environment a little bit. A lot of change going on, obviously. I mean, look, this is standard issue. Whenever there's a new administration, the winds will shift, and that's fine. And we adapt to that. And we've been doing this a long time. But obviously, a lot is changing. I'm not going to get into any reg level specific things. I'm going to be having some people coming on in the coming weeks and months that are really super deep experts around this. And I know enough to be dangerous when it comes to the compliance area. So I'll mostly stick to my knitting, which is around risk management strategy. So I don't necessarily want to talk so much about the compliance aspect as more just the general regulatory environment. Some of this is observation. Some of this is my perception, my views, and do with that as you will. Some of this will be controversial, and that's okay. I've never been afraid to put controversial things on the table, and we can talk about them because, again, nobody's going to go out there and do this just because Eric said so. Number one, I really do think that the CFPB should be eliminated. And again, I've already now ruffled somebody's feathers. Obviously, this was a result of Dodd-Frank, which for me was the worst piece of banking legislation in the history of the country. I think its structure is arguably unconstitutional. It really serves no fundamental purpose. The other agencies have always been able to handle consumer harm. Now, the question was, what were they doing a sufficient job? And that's a fair question. But they can. And I think really its only real purpose has been just to collect fines. And again, apologies to anybody that feels strongly about this, but again, I think the problem is that it really is not serving a value proposition. And I can't frankly see how it has really served a great purpose since its inception. In fact, many ways it's complicated things because, there are some, areas of regulatory themes that, multiple agencies cover, things like, UDAP and things like that. And again, anytime you've got multiple agencies enforcing things, you're going to have problems. So I think a lot of problems could be solved by just saying, look, this was a failed exercise. Maybe we need to step up how we cover some consumer protection within the existing agencies. Fine. I think that's a fair conversation, but it's not worthy of a whole separate agency to be able to do that. Second, and a similar theme, and I've been saying this for some time, I really think that we need to rethink our whole supervisory structure. I think we have too many agencies. And it just creates real problems. And I've talked to a lot of colleagues about this, and pretty much everybody agrees, some more visibly and vocally than others. But even in the shadows, I have people say, yeah, that probably should happen. It just doesn't make sense to have 5 different agencies with supervisory authority. It never has. And again, it just leads to problems of inconsistent enforcement. And even within agencies, within regions, I've seen inconsistencies. I think that we can find a lot of efficiency, improved oversight, and eliminate some of the vagueness and some requirements by collapsing those. I think there could be a case to be made that the Fed has enough to do in managing monetary policy. The FDIC has enough to do in managing the insurance fund and that part. And I really think we could collapse into one agency that is supervising the majority, if not all, institutions. In terms of field examinations, and again, I know many, and these are very fine people, and they really, really do mean well. But I think there's areas where even there could be some improvement. I think my observation is there's still not always good at being able to look in the right corners. I'm always a little surprised when an exam is over and something smoldering over there and nobody asked about that. Now, again, I think that there are areas they know they have to focus on, and a lot of the basic blocking and tackling, I think, do a very good job of examining and working with institutions. But I still think there's room to improve in overall plans and what is looked at. And again, with respect, and in part because risk management happens to be my principal focus, I think they could do a better job in evaluating risk management programs. When I look at institutions that go through things like a safety and soundness exam, I'll see a range of how they look at risk management programs. Sometimes it's kind of a control level, and I think, why? That's audit's job. Sometimes it's broad program governance level, and do you have good governing programs? And that's good. I think those are good questions in saying, do we have the right programs in place to really govern? But I would love to see more fundamental questions being asked. And anytime I've talked to an institution about their risk management program, one of the first questions I always ask is, when you think about your risk management program and all of its components, is it helping you make better business decisions? It's an absolutely acid test question that goes straight to the heart of whether the program is creating value or not. And I can say that in the overwhelming majority of cases, when I've asked institutions that, the answer is no. Now, that can mean a range of things. It can mean that really it's just a complicated way of testing our controls, of looking at our operational risks. But is it helping you make better business decisions? That is the critical question as to whether the program is creating value. Now, what that means is that the program is looking at areas of strategy. Too many programs are too grounded in operations. We'll get into this much more in the next podcast where I talk about risk management programs and I break it all down. But are they looking at strategy and tying strategy to risk appetite and to execution? And then asking the kind of business level questions that are getting managers to really question, and senior level executives to question, why are we doing what we're doing and does it make sense? So this is what I would love to see from the examiners is the first question you ask is, okay, show us how this program helps you make better business decisions. Because at the end of the day, that's what risk management really is. And then from there, you unpack it down. Okay, what do your programs look like? Your governance structures, and then policies, and programs, and then all the way down to execution, and how do you manage risk all the way down to the ground level. So again, no disrespect, but I think this is an area where examiners could improve, and I think it would just push banks further to be able to improve their programs more. Next, and again, this is more of it's an observation and a sympathy point. The reality is that we're going to be seeing more digital currencies in the ecosystem, whether we like it or not. Now, I'm not saying everybody's going to adopt Bitcoin. No, I'm going to talk about crypto. But the reality is that some form of digital currency or digital system is going to become part of the ecosystem sooner rather than later. And regulating this is going to be tricky. I do not envy how this is going to happen. Up until now, we've had it easy. Every transaction had to be done in a fiat currency, which has a supervising, issuing sovereign authority. Life is good. You've got somebody you can go to. It doesn't work that way in the digital world. There is no central owner. There is no central authority. So we're going to have to rethink how we work with a digital environment and how do we enforce some level of control. And again, I'll unpack this more when I talk about digital. And what's going to be important to understand, there's a distinction between currency and technology. So I'll come back to that. The question that we have to ask is, when we think about the technology of like a blockchain, in many ways has some superiority to a lot of capabilities, but is it superior because it's superior or because it's more obfuscated? It's harder to control. These are questions we're going to have to wrestle with. And at a supervisory and regulatory level, we're going to have to think about this. But the reality is, if enough people, institutions, industries, businesses over time, adopt a digital platform for transactions, suddenly the government's going to be able to control less and less that's happening in the dollar. I'm not saying it's happening tomorrow, so everybody just relax. But I am saying that we're fighting gravity if you think it's not happening or going to be happening. It's a reality we're going to have to live with. And so this is something I think going to be challenging the regulators. And for any regulators who are listening, you really need to be getting ahead of this and thinking about how we're going to manage a world that is a multi-currency environment, which may include a digital element. And number 4, I think we're going to have to take a look at the credit union charter and address the fact that there is an inequity between how credit unions operate and how banks operate. Credit unions had an original purpose that was very focused, but at this point they are functionally acting as banks. They're offering the same sort of product services. It was, not just consumer, but now commercial. And I think that banks raise a very legitimate concern about how there are differences, most notably, the fact that they don't have the same tax structure. So this is not going to be easy. I think this is just going to take some discussion, but I think it's something that the regulators really need to take a look at and decide if credit unions are acting like banks, then does this structure make sense, or does it make more sense to charter and regulate them more like a regular bank? Again, this is not an obvious answer, but I think at some point we should address this inequity. Similarly, I think the NCUA, again, all due respect, needs to just go away. It's not a strong regulatory agency. I think, again, it could be collapsed into one of the larger supervisory agencies. Again, there would be efficiencies here. We would ensure that we are supervising on a similar basis. And I think there's kind of some clarity around some of what's applicable, things like that. So, again, I know that could be very controversial, but there, I said it out loud. So let's have a dialogue. Let's talk about these and figure out what the right answer is. Okay, we're going to take a quick break for a short commercial message. We'll be back in 60 seconds.
One of the most important questions you can ask about your enterprise risk management program is it helping you make better business decisions? Or is it simply taking up a lot of people's time without creating any value? Is it helping you gain a better understanding of your business? Or merely documenting what you already know? The tools and resources available from ERM Advantage are built specifically to help any organization get the most out of their risk management programs. We have the largest library of free content covering proven best practices in enterprise and operational risk management. We have developed industry-leading tools and templates for every aspect of the program, including risk appetite, risk assessments, risk monitoring and reporting, and so much more. All available at a fraction of the cost of developing these tools from scratch. We are ready to assist you with program development or enhancements, board or leadership training, or reviews of existing programs. Contact us today to see what best-of-breed risk management can look like in your organization.
All right, we survived the regulatory environment. Let's talk about a couple of different key areas of moving parts and some observations around each of these, starting with just data. And this is a topic that has been a kind of a peeve of mine for quite a few years. The fact is that a company that doesn't take full advantage of its data cannot compete. And this has always been true, but it's going to become more and more prominent as banks get better at leveraging their data. And there are already other industries that do an extremely good job of analyzing its data and understanding its customers, and banks have a way to go in general. After people, your data is your most important asset, and yet almost every institution I've ever seen underuses the information they have literally right under their feet. So simply put, and sort of the lens to look through is that you have to be able to have mechanisms to use data to understand patterns, preferences, and profiles. These are key areas where, again, there's gold in that information if you just take the time to get the data and use it. And I know there's like data access issues, data quality issues. Again, we've had this forever, and we can't ever seem to get over this hump. But the question we have to ask ourselves is, again, going back to my point about being more customer focused and knowing what they want before they even know it. have to ask the question, what is our customer going to need in 1 year, 2 year, 5 years, 10 years? And many institutions do this and are getting better and better at it. But it's really going to become important. If we're going to be successful, we've got to be able to be proactive in how we are serving our customers. And this is both in terms of just general trends of what people are looking for in financial services, and all the way down to individual. What do my customers need, both at a consumer level and at a business level? This one bugs me because so few do it. And I get that it's a tricky one, but it's what's profitable. I'm always surprised and more than a little disappointed that every institution doesn't know exactly what's profitable. Which of our products, which of our locations, which of our business lines. And the story I always get is we just don't have the data. Nonsense. You absolutely do. That's a nonsense explanation. You just haven't taken the time to go get it, find it, scrub it, organize it, analyze it. And frankly, sometimes it falls under the heading of don't ask questions you don't really want answers to. If you've got an environment that it supports somebody's pet peeve product that hardly anybody wants, but to them it's critical you have, okay, it's a bad business decision, but it's your decision. But again, if we're going to be able to compete in an environment that is becoming increasingly more complex, increasingly competitive, increasingly fast-paced, you're going to have to be able to be honest with yourself about what of our offerings makes sense and what doesn't. And frankly, being able to jettison things that just don't make sense. Usage patterns. Again, what are your customers telling you based on their activities that they could need? Now, there's a really interesting side story here. It's an interesting case study. If you're interested, go take a look at it. Many years ago, Target did an interesting exercise. They hired a statistician named Andrew Pohl. And what they were trying to do was to see if they could determine from customer purchase activity which customers were likely to be expecting, maybe even first time expecting. Because if they could figure that out, they may get ahead of marketing products to them that they might be able to sell them before they get it from Walmart or Market or wherever. And what was interesting about this is they exceeded, almost failed by success. And again, it's a good story, but there's a lot of nuance to it that's worth looking up. Bottom line is they began analyzing the data, and the customers were purchasing items that weren't diapers and formula because the baby hadn't come yet, but they were able to tell from their purchase patterns at a very high confidence level that they were expecting kids. And so based on this, they started sending these couples coupons for things like diapers and formula, things like that. And it completely freaked out their customers. Like, how did you know we're expecting? So they had to say, okay, that was a bad idea because we sort of weirded out our customers because, how did they know that? So what they did is to soften that, they ended up just selectively weaving those coupons into flyers with coupons for cat food and other products that was more innocuous, and that everybody calmed down. So again, a victim of their own success, and rather amusing that they did the job too well. But the point was they used their data and they looked at what was the spending habits of their customers to be able to sort of figure out where are they in life and where are they going. And I think the reality is if you looked at other people's spending patterns, you might be able to tell these are people working to buy a home. They're looking to go to college or something like that. Are there ways we could use our data to better understand our customers and what their needs may be today, tomorrow, next year, 5 years from now? The reality here is that 90% of what a bank does should be data-driven or at least data-informed. Running a bank based on instinct. Well, we've always done it this way. We've been doing this a long time. We know our customers. That's a death march. That's not a viable model in the long term because, again, the successful banks in a more competitive environment are going to be able to use data to do things more efficiently, more optimally, and really be able to anticipate their customers in the way customers feel like you understand me, you're providing me the things that I need. Now, let's talk about digital and the whole digital world. And this is going to be a complex one. We're going to have to break this down a bit. we hear a lot of noise about crypto and blockchain, and it's going to change everything. And the truth is in the middle. Yes, there's going to be changes that are coming, but we have to moderate what that means. And again, be able to think about how we could exploit this or defend against it. Now, I'm going to do a very, very quick primer on digital currency. I'll do another video. I'm going to do a training video on. I'm going to break down blockchain and all the different cryptocurrencies in more detail. But I want to kind of do a primer here. So when talking about a digital currency, there's a distinguishing between a digital currency and an electronic currency. And people say, well, isn't the dollar already digital? In the strictest of terms, yes, but it's not a digital currency. There's an important distinction here between an electronic currency, which the dollar is and all other currencies are, versus a digital currency. And it is this. For an electronic currency, such as the dollar, it exists because it is registered in a ledger. It's in a ledger somewhere. It's on a bank's balance sheet. It's at the Fed. The dollar exists because it's on a balance sheet. It's in a ledger somewhere. That is proof of its existence. That is what makes it real. It cannot exist outside of a ledger with the exception of cash. Cash is the one thing that obviously it's something you can have and hold. It's a bearer instrument, but outside of that, all the other electronic forms are electronic, but they exist because they exist in a ledger. Digital currency is different. Digital currency, Bitcoin, all the Ethereum, all the other coins, they exist because of an encryption key. And that encryption key is recorded somewhere, and it could be on a blockchain, just an electronic ledger, or it could be taken off that ledger and literally be written on a piece of paper. And the only existence of that currency is via that encryption key that is either written down or is on another electronic system in a digital wallet. There's a variety of ways that it can exist, but the key thing to understand is that the currency can be removed from any platform. Like cash, it can exist outside of a ledger. Okay, now again, there's a lot of nuance to that, and maybe I've lost you already, but that's an important distinction for us to understand. Because what that means is, and this is why the technology is so significant, is it allows for the ability to transact in a way that is uniquely different than the dollar because that currency is transportable. It can go with something else. And in addition, we can do other really interesting things on blockchain ledgers. We'll talk about that. Next, we talk about the currency. And currency is one of those much debated things, but loosely, and this is not perfect, but it's serviceable for this discussion. The currency has several attributes. Number one, it's a store of value. It has value. The dollar has a value. It's somewhere I can store value is in that currency. I can hold dollars, yen, whatever. It is a medium of exchange. I can use that dollar to purchase something. I can transact with it. I can exchange that dollar for something else. It's a unit of account. It tells me if something is worth something. That something is worth $100. So that's a unit of account. It gives me a reference point as to what something is worth. And generally speaking, it is backed by something. For all fiat currencies, it's backed by the faith of the issuing government. So we look at this and we go, okay, what of these does a block or a Bitcoin satisfy? It's not a store of value because it has no store. Its only value is what somebody perceives it to be worth. It's not really a unit of account because what a Bitcoin is worth today is not what it's going to be worth tomorrow. So it's very volatile in that sense. And it's not backed by anything. It's backed by what somebody is willing to exchange it for. So we pretty well rule out those three. What it principally is showing a possible value is for that unit of exchange. It's the one area where it really does have a currency-like attribute because I can give you a Bitcoin or an Ethereum unit of value in exchange for something. So that's where there is some value. But here's where we have to separate the currency, if you just allow me that usage, or the coin from the underlying technology. And this is a very important distinction because pretty much all the coins we see today are really just novelties. They really have no broad commercial adoption. There's some limited use cases, and we will see more. But that's really not where the value is right now. Right now, what is intriguing, where value is in the technology, the blockchain, because a blockchain, which is, again, it's a ledger mechanism to be able to record a digital currency, has a lot of really interesting capabilities. And I don't want to go down this path because I'll be here all afternoon. But what's important to understand is that we talk about the value of the digital environment. It's not the medium, the coin, it's the method, the technology. And that's what we have to accept, the fact that there are a number of very notable use cases for a blockchain that we're already seeing being adopted in some significant ways, even some institutions that are developing their own blockchains. That part is here to stay. So we need to be thinking about, what does our bank look like in an environment that is next to, either adjacent to, or taking advantage of various blockchain technologies. Now, hopefully that was enough to be able to serve the basis of the discussion. Now, once we've established that, again, the technology has some value, and we need to be thinking about how blockchain may fit into our strategy, there are three types of currencies that can exist in this environment. Again, this is an important distinction. Number one is a stable coin, which is any kind of a coin which is tethered to another asset like a dollar. And so if it's one of this coin, it's worth $1, and they're tethered together. That has some merit, and right now the administration is looking at for use cases with a stable coin because, again, you don't have the price and stability of a market-driven coin like a Bitcoin. And so now you can start to consider some of these use cases like a medium of exchange using a stable coin. And you might think, well, what's the point? Just do it in dollars. There are some real advantages to being able to do something on a blockchain, not the least of which is things like international settlements, multi-currency transactions. There's some very legitimate use cases, particularly at kind of a wholesale level, where a stablecoin could actually have value. The second is your crypto. It's your Bitcoins, it's your Ethereums, it's your Dogecoins, and all the other nonsense ones. This is worth considering, looking at, understanding, but it has no use within our current ecosystem. There is no use case for a Bitcoin being broadly adopted within the banking system. It's not going to happen. Again, it will be tangential, and so banks may bank the companies in that ecosystem, but very rare they're going to be taking a custody anytime soon. And if anything, it's just custody. We'll hold it for you, but we're not going to allow you to transact in it. And the third would be a central bank digital currency, or a CBDC, which I've said before and many times would be a spectacularly bad idea. Not something we should be considering, and the administration is looking to actually put out legislation which would actually ban it. Yay, please do. I've got an article I've written on this that I'll post to my website. But again, this could be devastating to our financial system. It is a stunningly bad idea. It has no place within the U.S. financial system. It has a place in other countries where they want central control, so more of a socialist environment. Yeah, it makes a lot of sense. But in our environment, there is no place for it. So the use case is really how we use a blockchain, or multiple blockchains, and how we might be able to use a stable coin. Now, again, we need to consider the fact that we're fighting gravity on this, and we might want to say, why don't we just ban all of this? No, it's like banning oxygen. It's not going to happen. There's a realization that the technology has some potential use cases. So again, we want to be thinking about and keeping an eye on what are increasing uses of blockchain technology, and it's already being adopted in some ways. And there are some very interesting use cases. Be looking at that, be exploring and keeping an eye on how you may be able to take advantage of that, because it is not that hard to be able to participate in a platform, and more often than not, it's using a third party or a fintech that uses blockchain technology to be able to offer products and services. And again, I'll leave it to you to unpack that and explore that. I will have some folks in future podcasts that they live in this space, and we'll talk about those in more detail. The last thing is that we need to consider also, and this talks about the future of banking, is also recognizing that, again, right now we have the luxury that our whole system is based on the Fed system, based on dollars. I think the reality is that where we're going is that we are going to evolve into more of a wallet-based environment. Now, what does that mean? A wallet, or digital wallet is, a digital a place where people can basically store value. So if I've got Bitcoin, I can put it in my wallet. If I've got, in theory, dollars, I can in theory put it in a wallet. So it's a reimagining of how we transact, how we record information and units of value, and this is coming, and it's really here. There are some of the money center banks have already started introducing the idea of being able to hold wallets. The advantage here is that it opens up just all kinds of really interesting capabilities. We can offer our customers the ability to transact in cross-currency, multiple currencies. And frankly, it's not just currency, not just fiat currencies, not just digital currencies. You could literally transact in anything that can have a defined value. So again, I only mention this to say, because I know that all the major service bureaus, the FISs, the Fiservs, the Jack Henrys, they're all exploring this. They're all looking at offering a wallet. What does that look like? You should be talking to them about this. And what are we going to look like in the inevitable future where we are going to offer a wallet capability to our customers? This, again, is fighting gravity. This is not one where you can say, yeah, we're just not going to do that. You're not going to be a bank. That's the reality here you need to understand and be thinking about what are we going to look like when we're offering much more technologically advanced products and services that are more wallet-based and less Fed-based. Now, there's a broader, trickier question of what happens if we end up with a critical mass moving to wallets and away from the Fed. But that's a bigger, much more existential question. One last final thing, and only because I've had a couple people sort of mention this, and I hesitate to, but I just want to at least be able to say it. There's been some noise around this idea of a quantum financial system, this quantum event. And this is a theoretical paradigm shift involving quantum computers and digital currencies that would eliminate everything we know today. It would eliminate the Fed, and it would totally be the ultimate democratization of financial services, this freeing of the money supply. Not going to happen, at least not in our lifetime. This is flat earth stuff. Number one, quantum computers are decades away from having any real commercial application. At the end of the day, the Feds still make the rules about banking. So this is intriguing stuff, and I think, again, I'm not saying it can't, but because obviously the trajectory of quantum computers is very much going to be, developing systems that are infinitely more powerful and capable than anything we see today. But again, these are in their infant stages. And there is nothing that's going to happen that is going to eliminate all of the rest of banking. So that, again, there, I said it. All right, let's talk a little bit about AI. This is the thing that everyone wants to talk about. AI is going to change everything. Well, we'll see. I want to break this down a little bit and talk a bit about what I think AI is and how it is, in fact, going to have meaningful impact and how it may or may not. Now, AI naturally divides into two components: machine learning and its ability to replicate, human ability, human interaction. Now, these have two very separate trajectories, two different use cases, two different impacts. Now, the human-like aspect has some promise in areas like customer service. Certainly interacting with a bot, and I got to admit, these are getting really good, is certainly far better than interacting with godforsaken, menu prompts. Press 3 too. These really are getting quite good where companies are using them and you don't even know it. You're interacting with a computer and you just would never know. There is some potential there. The linchpin is going to be whether customers ultimately become comfortable in talking with bots more than they like talking with people. Frankly, I've talked to some bots that were a lot smarter than people, so I'm not necessarily opposed to this. But I think there are some interesting use cases in being able to use some of this to, provide some customer service in ways that are a little more predictable, consistent, and I think have some interesting applications. Let's talk about the machine learning component. So when we talk about machine learning, it's basically using technology to be able to learn, adapt, and do things. And there's fundamentally three ways that this plays out. Number one is just information management. It's allowing a technology to ingest large amounts of information, analyze it, interpret it, organize it, and provide access to it in meaningful ways. This has absolute real-world application. We're already using it today, and this is a profound way that AI is going to have a meaningful input and meaningful capability as we get more and more data and being able to manage and use data. The second is generative AI. Obviously, if you've used a ChatGPT or Gemini or Grok or any of those, you've used generative AI, and some institutions are sort of experimenting with this in ways of using. And I think there's very interesting use cases. I use it a lot. I use it a lot to create some preliminary content that I can then fine tune, and I'm stunned at how good it is. Now, some of it comes out nonsense, and I've had some stuff I went, oh my God, what kind of drugs were you on? The bot or the AI agent. So it has to be evaluated, obviously, but those are ways that it's basically creating efficiencies and being able to use technology in some very, very smart ways. And the final really is more decisioning, and this is the one where there's much more limited use cases. So am I going to let my AI evaluate my underwriting criteria and decide for itself to add new criteria? Well, no. So again, when we come to the final sort of chapter, or the final way that AI could be used, which is actual being able to decision make, this is where I see very limited use cases, because at the end of the day, we need to be able to control what it's doing. And so that's okay. It doesn't mean we don't have tremendous use cases, but I think it does limit, what could be sort of the downside or damage, from an AI agent sort of run rogue. AI is absolutely going to influence banking in the same way it's going to influence all industries. There's absolutely no question. However, I think 99+% is going to be those first two. It's information management and generative AI. I think very little in the letting it do its thing. There's no Skynet scenario, at least not in our lifetime. I think some of the key use cases that I'm seeing that I think make a lot of sense, that are very logical use cases. Number one is in financial crime and being able to do transaction monitoring. The simple fact is that, in financial crime, there's this huge pile of transactions, and letting an agent analyze that data, I think makes a lot of sense. And being able to look for patterns that a human might not see, because they're more subtle or based on a very, very large data set. Underwriting, certainly. Again, I think this is just more optimization, but I think that's an absolute use case. And again, really helping to suggest patterns that the bank may want to consider. Information management, just certainly being able to organize, interpret information and be able to get quicker access to it, to more meaningful, 100% a viable use case. Customer service, I think being able to do better customer service, absolutely some very, very important use cases there. And just optimization, just process optimization, or content creation, all of that. I think there's a lot of really good opportunities there. These are all very, very good use cases, but in many ways, they're really just better, faster, cheaper. I don't see them as necessarily game-changing, but I'll reserve judgment. And again, I look forward to bringing on people they live in this space, they're seeing cutting-edge uses, and I may change my mind. But I think right now, I don't see this as necessarily a game changer, as opposed to just tools that institutions have to be able to use effectively if they're going to be competitive and they're going to be able to keep up with what others are offering. Honestly, I'm way more concerned about a potential loss of quality than I am loss of control. People that are just allowing for generative AI and going, yeah, fine, that's fine, without evaluating it. And that's a problem, because these agents are not perfect. And even though they've been trained and what they're spitting out may look reasonable, it still needs probably human hands to evaluate, does that make sense? And then on a related theme is just the whole fintech world. I don't have a lot to say here because, again, this is really obvious on the trajectory we're on. Many fintechs are doing a good job of partnering with banks, again, being able to bring better, faster, cheaper. Others will intend to compete with banks, and I think that will continue to be the case. Many are going to really look like banks. But here's my view, and it goes back to what I said earlier about a bank's principal value is trust. If banks and banking industry does a good job of protecting that trust position and leveraging its offerings based on the expectation of people trust us, then I think you'll always have a leg up on what a fintech can do. I think a fintech can participate in the space, but I don't ever see fintechs displacing banks. I just don't see it happening. I think there's too many ways that a bank can continue to bet. So the question becomes, strategically, how do we leverage that trust position that continues to make us unique? Because your products are not unique. Your great customer service is not unique. We've better figure out how to leverage that trust value so that we do remain unique in some way. So I don't see them being an existential threat, but I do see them being a threat. The question is, in what way? Now, I think key areas where I think it's important to think about how you partner with fintechs, and really all banks really are. So I'm kind of telling what you already know. Certainly, anytime they've got unique skills, they have unique expertise, unique capabilities. Certainly, yeah. I mean, why buy or build that capability if you can rent it from a third party? Prototyping. We want to try this new product, but I don't want to build out the team and the infrastructure to do it. Fine. That's a great way to prototype an offering, is just use a third party. That's what they do. And it's certainly exploring more complex offerings. Again, why bring in a capability if I don't have to? So again, I know I'm saying the obvious. You're doing that, but that really is the area where I think you can leverage a fintech. And then if you decide that, look, this is something we want as part of our permanent offering, maybe think then to build the capability stack internally. So you can, bring that in, maybe just acquire the fintech, take out their competitive element. But again, I think that's a decision you make once you decided that the use case makes sense. In any case, one area I do challenge clients and all institutions is really look at your third-party oversight. I mean, when it comes to these third parties you are partnering with, you need to have top-shelf ability to manage the third party. And this is not getting their SOC report and their insurance cert and do they have this document. No, that's you do that with the companies that water your plants. If you're working with a fintech, and particularly if one where you're doing something as like a banking as a service, you've got to be able to have third-party capabilities that go above and beyond to understand what they're doing, how they're doing it, especially if they have any contact with your customers. Again, you've got to have world-class oversight and monitoring capabilities so that if something goes sideways, you find out about it now and not a quarter from now when you do your QC reviews. Again, I know you know that, but it's just worth saying. And I want to round this out just by talking a bit about the future of banking. And I've been talking about this throughout, but again, I just want to kind of offer some observations and some thoughts. And as you think about how you do what you do and your strategy and all of that, just a little bit of sort of the crystal ball, department. We don't know the full effects of things like AI and fintechs and crypto and blockchain. Does a future state, do to banks what Amazon has done to retail stores? Does a future state relegate banks to being purveyors of buggy whips? I don't know. I don't think so. And again, I think if banks are smart and continue to do smart things and really think seriously about how they can leverage technology and really service the customer of the future, I really think there is a place for banks. But the truth is, 10, 15, 20 years from now, we're going to need banking. Do we need banks? And that's a hard question to ask. So again, the questions you should be asking when thinking about strategy is not, how do I sell more product? How do I close more customers? No, That's not the question you should be asking. I mean, at a business unit level, fine. That's part of just your own business plans. But at a truly strategic level, the conversation that you should be having, the questions you should be asking is, what will banking look like in 10 years? We've got to think about a long game. In 20 years, what are customers going to want? What is a transaction going to look like? How do we create value, not just sell product? Let me say that again. How do we create value and not just sell product? How do we maximize technology to be able to serve our customers, to be able to analyze, predict, anticipate? How do we make interacting with our customers, whether online, mobile, or live, as frictionless as possible? Because that's what the technology companies are offering. There's nothing to say that banks can't keep doing what they're doing. Just do it better, and that's fine. But again, I think there's some things that we need to really get serious about. Number one is having a clear vision of where you're going. What do we want to look like in 5 years? That is the linchpin for a strategic plan. If all your plan is just a bunch of transactions or activities you're going to do, it's not a plan. Okay? What do we want to look like in 5 years? Have a clear vision and communicate it out. Get better at using data. Have a really serious conversation. Put a bunch of senior people in the room with some of your operational and technology people and say, we want to understand the data we have and how could we be using it better? What capabilities could we bring to ourselves? How much could we be doing things better if we used our data more? And how do we do that? And then do it. Be serious about doing it. Be able to anticipate customers' needs and not just reacting to them. Again, using the data in ways you can predict and then better serve. Invest in both strategy and in risk management. Having a good, clear strategy that isn't just an operational execution strategy, but a good, clear strategy combined with a strong risk management program. And again, in the next podcast, I'm going to dedicate that to going through what risk management means, what it looks like, what mature looks like, and why strong risk management is going to be critical to surviving long term as banking is changing. So there's some great stuff in there. Risk management really will help to navigate the change and help us adapt and thrive as we go forward. Again, I'll say it again, if you ground your value proposition in great service, you're on borrowed time. I know that's a tough truth. But the reality is that we need to be grounded in where we're going, how are we going to get there, and how are we going to service the customers of the future. Now, again, I've let out a lot of stuff that's somewhat provocative, and you're welcome to agree or disagree, and certainly can leave comments on the site. In future episodes, we'll be unpacking all of these points as I bring in guests, subject matter experts, again, in the industry, strategic planning, in the regulatory environment, and enterprise and operational risk and financial crime, technology, operations, and so much more. And I'm very excited to be able to bring in colleagues that will challenge my thinking. They may echo it, and they may add additional layers that I hadn't even thought about. So I'm looking forward to being able to use this platform to talk openly and honestly, get others in here. And if you've got ideas on future podcasts or topics, at the end, there'll be an email where you can send me an email, and I welcome your thoughts. So for now, thank you for listening.
The ERM Advantage podcast is recorded at Lightshed Studios, Philadelphia, Pennsylvania. Copyright 2026 ERM Advantage, LLC. All rights reserved. To inquire about appearing on the podcast, please contact us at ermadvantage@gmail.com.